Good morning, everyone. How's everyone doing? All ready to talk about an exciting topic, state taxes? My name is Craig Cookle. I'm a partner with Withholding. I've been involved in state and local tax consulting now for a little over 26 years. I actually started out as an auditor with the Wisconsin Department of Revenue for a number of years, so don't hold this against me that I'm from Wisconsin, okay? I'm involved in multi-state tax consulting. So I think the topic that I want to cover today is really kind of a high-level overview of multi-state tax filings. And maybe 10 years ago when I would meet with clients, the topic of multi-state tax filings never really was at the forefront. It was more reactive versus being proactive. And what I mean by that as far as being reactive is maybe the company was doing business in a state and they would wait to hear from the state. You get a love letter in the mail as far as, are you doing business in the state? We want you to fill out this Nexus questionnaire. And they would address the multi-state filing requirements under that basis. And I would say over the last maybe 5 years, besides state audit defense, multi-state filings is probably the number one issue topic that I hear when meeting with clients and prospects, because as we'll go through here today and talk about the various states and topics, states are being very aggressive in trying to find additional revenue. It looks like Larry mentioned earlier, Illinois is not in great shape and a lot of other states are not in great shape. So from that standpoint, I think a lot more companies are being proactive and trying to understand what requirements they have to file returns in other states. So there's a number of things I want to cover today. First, I'm going to talk about why is state and local tax such an area of scrutiny. How are states finding non-filers? What methods are they using? We'll talk a little bit about maybe basic principles of Nexus. I'm not going to get into an in-depth discussion because honestly, you could probably have a whole day discussion just on Nexus all by itself. Some questions that you might want to ask yourself when it comes to multi-state filing obligations. Where my obligations fit into there? And then why is it important to address state and local tax issues proactively? So we'll talk about that. And then lastly, we'll wrap up with compliance and minimizing exposure risk. And actually, understanding where you might have some filing obligations. What might you do to determine what your risk might be? So why is state and local tax such an area of scrutiny? So when you think of state and local tax, it's a broad topic. It includes a lot of different taxes. So not only sales tax, income tax, franchise, we'll talk about non-income tax and gross receipts tax, but property tax and withholding tax. State and local tax includes a lot of different areas. You probably could put, although it's not a tax, you probably could put unclaimed property in this category too as well. States are really after companies with finding unclaimed property these days. Next, the budget deficits have forced states to become more aggressive and creative in seeking tax revenue. So they're doing this through a number of ways. A lot of states are adding additional auditors. Wisconsin just added 100 auditors a couple of months ago. And so now they're training those auditors. Minnesota, a couple of years, added additional auditors. State of Washington added auditors a long time ago, maybe 3 years ago. But the key thing here is, as far as being aggressive, the states are adding more resources to go after more companies from an audit perspective. And as far as getting aggressive, I'll cover this in the presentation. I'll talk a little bit about it right now. But if you're selling at retail or even at wholesale and you take exemption certificates, years ago when an auditor would come in and you would be going through an audit, they just look to see if you had that piece of paper. Nowadays what they're doing is they're actually diving into that certificate and seeing, well, hey, is it missing a signature? Is it missing a box on the reason why something is exempt from tax? So what I've been seeing more or less in state audits, as far as the auditors getting more aggressive, is they're making you go through the hoops of getting a completed certificate from your client or from your customer. States are better able to utilize technology tools, and they have information sharing agreements with other state agencies. So a long time ago, when you talk about all these different tax types, a state would have maybe sales and use tax on one software system. They might have income tax on another system and withholding tax. And so it was very difficult for states to cross-reference to see who might be filing a sales tax return but maybe not an income tax return. So now with technology today, what states are better able to do is they're able to combine all of their tax types onto one system, so they talk to one another. So as they're able to talk to one another, they're able to find those companies that might be filing maybe just sales tax. Why aren't you filing withholding tax? Why aren't you filing income tax? Businesses no longer operate as just a local brick and mortar shops. They're doing business online. They're reaching out to more states. Changes in technology and methods of doing business have introduced complexities often not anticipated by those drafting state tax legislation. Larry talked about a topic a little while ago, software as a service. This is from a state tax perspective. There are a lot of states out there that have not, they've taken positions as far as whether cloud computing or software as a service is taxable, okay? But a lot of times their administrative code or their regulations or their statutes don't support that. So an example of this is recently over in the state of Michigan. There was a case involving auto owners, which is an insurance company. So basically what happened is this was a software as a service case, and the state of Michigan lost. So what the state of Michigan was asserting is that what the taxpayer was purchasing was tangible personal property. But what the courts looked at, and when you think about software as a service, one, usually the user is accessing the software via user ID and password. The user does not have control over that software. It's usually on a server by the vendor. And there might be some software incidental to connect to that particular software program. But really what the Court of Appeals in Michigan looked at was that really what was being provided was a non-taxable service, a professional service. So here's a case where Michigan thought they had a position to take that somebody was obtaining tangible personal property, and they lost. So now, from what I've heard, is that this is a situation where the governor's not happy with this result. Michigan may not appeal this any further, but there's talks that they're going to introduce legislation to correct this so they can tax SaaS on a go-forward basis. So, here's maybe a case from when you think about software. I mean, these software systems that the companies are putting in, $200,000, $500,000, $1 million and on up, that's a lot of sales tax revenue the states are losing out on now from going from a server-based solution to a cloud-based solution. So I would imagine, Larry too, I would imagine other states have been watching this case and may change their rules or regulations to try to tax software as a service, possibly. Left unaddressed, the liability can be significant. So if you're not filing a return in a state, there's no tolling of the statute of limitations. So a state can go back as far as they want, typically, unless they're prevented by regulation where they can only go back maybe 8 years or 10 years. But think about this, if a state can go back as far as they want, not only do they have additional tax, but the interest and penalties can add up to as well. So manufacturers aren't alone on this. So really it's everybody. It's all companies that are doing business throughout the U.S. that are really affected by state and local tax, including retail distribution, contractors, banks, franchisors, service and technology companies, including marketing and advertising firms too as well. Yeah, I just might want to add too, I keep this kind of informal, so if you have questions as we're going along, please feel free to interrupt me and I'll try to answer questions as we go along. So how are states trying to find non-filers? So again, going back to the earlier slide, matching programs, technology. They've combined all their systems onto one, all their tax types onto one system, so they're doing cross-check. Audits of in-state businesses. That is actually a good source of audit, or actually information for states to obtain. So say if your customer in a different state is going through a sales and use tax audit, what better information to get about your business than through that audit of that company in the other state? Because a lot of times the auditor might ask, oh, how many times do they come on site to visit you? Do they do installation? Do they do any kind of services? Are they doing any kind of training? So a lot of times, if a state finds you first through an audit of an in-state business, they're going to have more information on you than you realize. A lot of times, the Secretary of State, a lot of times companies will register with the Secretary of State to transact business as a foreign corporation, and they might not register for any other tax types. There's legal reasons we'll talk a little bit about why companies might file or register with the Secretary of State. But again, there's information sharing within the agencies within the state, and if they get that list, they might draw some letters to find out why you might not be filing returns. Information sharing agreements. There's many states have information sharing agreements where they exchange audit information and other information as far as sales tax between the two. As an example, you have CETA, the Southern Eastern Tax Administrators, which is comprised of 12 states down south, Florida, North Carolina, all those states together. And they actually have a formal information exchange program where they exchange information between the states on audits and tax and companies for compliance purposes. Business groups and trade associations, great source of information from a state perspective. It's so easy to if a state is going to target a particular industry or particular association, they pay them the money to get the data, and they start sending letters out to try to find who should be registered to collect tax. Websites. Everybody likes a detailed website, right, from a business perspective, because obviously, the better your website, the better draw you're going to be, or the better you're going to. If somebody's looking at you for prospective work, you want to be able to show that you can have what they're looking for. So websites are a detailed way for companies to find out, or for states to find out a lot about your business. And a lot of times before they even send letters out, or even auditors will actually visit your website because they gain a lot of information about your business as far as where you go, what you do. So Nexus overview, some basic principles. Again, this could be an all-day session on Nexus all by itself, but just some common basic principles. So when we talk about jurisdiction, it's really defined as a state's right to impose a tax on a particular person. So when we talk about Nexus, it's really that connection. It's really that connection of the business activities that a business does in a particular state or a locality that allows that state the right to impose tax on that company. So state of incorporation, Nexus is likely automatic. Other states are really going to depend upon the nature of the activities conducted within the state. One key thing here from a Nexus perspective, going back to the earlier slide, you've got sales tax, you've got income tax, franchise, gross receipts. Nexus can be different for each of the different tax types in various states. So when we talk about sales and use tax, what activities might a company be doing in a state that may trigger a filing requirement? Now, I guess the key thing here is activities that typically create Nexus. All right? So the rules and regulations from state to state are going to be different. There's really no bright line test for all states, but from a sales tax perspective, the key is physical presence. So when we talk about physical presence, do you have sales representatives going into the state to solicit sales of tangible personal property? Okay. Does the company have ownership property in the state? Do you have employees physically located in a state or providing services in a state? Selling services, leasing activities. So if you have a company is actually leasing tangible personal property. When that equipment is located in that state, that might be physical presence from a sales tax perspective. When a company contracts with outside parties, like a third-party agent, if they're acting on your behalf, that's also could likely be a nexus creating activity from a sales and use tax perspective. Warranty, repairs, and service contracts. So many times manufacturers or whoever, retailers, might subcontract out the service work or warranty work is done on a particular product, okay? So that arrangement that they have with those parties in those states would be enough from a sales tax filing requirement for a state to go after. Consigned inventory, if a retailer has or a wholesaler has inventory at a customer site or maybe at a warehouse, that could be a nexus creating activity. But the interesting thing is, again, it goes back to a state-by-state basis. You have to look at the rules and regulations as far as what, where consigned inventory would create nexus. Because Virginia just came out with the ruling maybe a week or so ago, and it must have been, they didn't disclose, they obviously don't disclose who it is, but it must have been related to Amazon, because the ruling dealt with if the only property that a company has in the state is inventory at a fulfillment center, is that enough? Is it enough property? Is it enough connection with that state to for that state to file for that company to file sales tax returns? And Virginia said that just having property or owned inventory in the state at a fulfillment center is not enough nexus for sales tax filing purposes, because what they did is they went through the regulations and that was not covered. So I thought that was kind of interesting, because normally when you think about owned inventory, owned property in a state, that's enough to trigger filing. Click-through nexus or affiliate nexus. Click-through nexus basically would be a situation, would be a retailer or somebody selling online. I have an agreement with somebody in another state where they're going to put my banner on their website. One of their customers goes onto that website, clicks through to go and buy something on my website. I then deliver that product into that state, and then I pay that company a commission for that sale that just took place. So right now I think there's about 15 or 16 states that have click-through nexus. And most of the states have similar legislation where you have that click-through, if that person selling into the state has more than $10,000 sales, that could be enough from a filing requirement for sales tax purposes too as well. Affiliate nexus really comes into play when you have more than one commonly owned corporation, where one corporation has physical presence in the state and then the other related party has or ships a lot of product into the state. It doesn't have physical presence on its own, but they use the services of that other company to maintain that marketplace in the state. So a number of states have enacted affiliate nexus rules to bring that other company that may not have a physical presence, they ship into the state, and the states want to tax those sales. So when we switch over to state income tax purposes, there's a different level of nexus that must be obtained, or a state must go after in order for somebody to start having to file returns in that state. So basically, if you have solicitation of tangible personal property and the employee salesperson has the authority to accept orders. Okay, we'll talk a little bit about Public Law 86-272 on the next slide. But when we look at the activities that actually create nexus for an state income tax purposes, that individual that goes into the state that solicits sales of tangible personal property, and if they have the authority to accept that order on the spot, that creates nexus for state income tax purposes. Obviously, the post-sale activities would create nexus too as well. But one of the things on this solicitation, many times, and I'll maybe reference this too when I talk on the next slide, but a lot of times what I find out when I'm meeting with clients is if they're only selling tangible personal property and they have sales reps that go throughout the state, what kind of language do they have in that salesperson's description, their position description. Because oftentimes when a state is looking to go after a company, just on this first bullet point, one of our arguments is, well, you know, the sales rep does not have the ability to accept the orders on the spot. They've got to be accepted back in the home state. And one of the things I always recommend is, you know, have you looked at that position description of your sales employees, and does it say specifically within that position description whether they have acceptance or not to accept those orders? And then the person back in the home state, you know, who is in charge back in the home state for accepting the orders? Is it the sales manager, a branch manager, or somebody else? One thing that definitely will create nexus from a state income tax perspective is solicitation of services. Again, we'll talk about Public Law 86-272 in the next slide. Performance of installation, training services, ownership of property, consigned inventory, leasing activities. Again, contracting to do warranty repairs and service contracts would be a nexus creating activity too for state income tax purposes. So I mentioned Public Law 86-272. So this is a federal law, okay? So if the only activity of a company in state activity is an employee who solicits the sale of tangible personal property, and the approval is actually sent back outside the state, and then the order is actually filled or shipped from a point outside the state, that company's activities from a state income tax perspective are protected. That state cannot go after that company from a state income tax perspective. But I think what happens with Public Law 86-272 is it only applies to the sales of tangible personal property, but it does not apply if that person is soliciting the sale of a service or intangibles, you know, like a franchise arrangement. So I think that's maybe one thing to you know, be aware of under Public Law 86-272. It only applies to sales of tangible personal property and taxes based on net income. I think that's a really important concept too as well. So when we talk about franchise tax, capital stock tax, gross receipts tax, generally the nexus creating activities for that are going to be similar to the sales and use tax requirements I had on the slide before. You know, a lot of times we hear, well, you know what, I'm only going into a state maybe a couple of times a year, and so my activities are de minimis, and so therefore I don't have nexus in that state. You know, what the state will look at is maybe, you know, let's just kind of give this example where you have a client in the state, maybe you'll only go in twice a year to solicit sales or do visits. Oftentimes what a state might ask is, well, do you do it year after year? Are you going in there 2, 3, 4 days a year, you know, for the last couple of years? And so what the states will look at is it regular and systematic? Are you going in there year after year? And if that's the case, the de minimis argument generally will not prevail. There was a case out in Washington not too long ago where a company, a retailer, just had somebody go into the state to visit a customer 10 times a year, okay? 10 times a year just to build goodwill, maintain customer relationship. And they weren't selling anything, but in that situation, the court held that that was substantial nexus. Those 10 visits a year create a filing requirement not for only the B&O tax, but the state sales tax too as well. So when we talk about the next point as far as we talk about franchise tax, capital stock tax, and gross receipts tax, we're seeing more and more states these days that are actually going to a system to impose tax based on some level of economic nexus. There's some level of economic presence in that state. There may not be physical presence in that state, but there may be economic nexus. So let me just kind of give you a little bit of background. Is in a couple of the states that have economic nexus for certain parts of their tax system. And I think, from my perspective, you know, going back to the state income tax, it's not always, you know, from a revenue perspective, from a state, they can't always depend upon those revenues to come in on a corporate income tax basis because maybe the economy's bad, companies aren't doing well, those corporate income taxes aren't going to come into play. But what they can do is if the state goes to like a gross receipts tax, similar to what Washington has with the B&O. I'll talk a little bit about Nevada, what they just implemented, the commerce tax. And then you've got Ohio with the commercial activities tax, and Michigan. But you've got a tax based on gross receipts. It's not based on net income anymore. So in the state of Washington, they just recently enacted legislation to impose tax on economic nexus, and they listed a couple of standards. And the B&O tax, is everyone familiar with the B&O tax in Washington? You know, because the state of Washington doesn't have a corporate income tax, but they've got this other tax where they get their revenue from, the B&O tax. But what the state of Washington did is they enacted legislation to impose tax on wholesalers that are selling into the state. And let's see, if they have one of these, they meet one of these 4 criteria. So if they have more than $267,000 worth of Wisconsin or Washington gross receipts in a year, if they have more than $53,000 of payroll in Washington, more than $53,000 of property in Washington, and at least 25% of total property, payroll, or income in Washington, they will have Nexus for the B&O tax if they're a wholesaler, okay? Now the B&O tax has got different classifications. They got a manufacturing classification, a retail, and again the wholesale. But this economic nexus only applies to the wholesale part. The retail part and then the sales tax is still based on physical presence. So the fiscal note on this which is kind of interesting, the fiscal note expects that over 12,000 businesses are going to be impacted by this new legislation. So I thought that was pretty interesting. And something that Washington did too, which is similar to what other states are doing too, is they actually have trailing nexus. So say if a company has nexus for B&O purposes on a wholesale in a given year, and all of a sudden then you don't have nexus, well, Washington is saying is that you have nexus for the remainder of that calendar year, plus the next calendar year too as well. A lot of states, what happens is if you end nexus, you know, you stop filing from a sales tax perspective, or it's at the end of the year from a corporate income tax. But a lot more states are going to a trailing nexus concept too as well. Maybe just one more comment too. The Nevada commerce tax, it's brand new. That again, Public Law 86-272 will not come into play as far as the nexus perspective. And so what it's going to be is if you have more than $4 million of gross receipts, $4 million or more of gross receipts in the state of Nevada, you may likely have a filing requirement in that state. And again, it's a tax based on, it's going to be based on your NAICS code, and there's different level of rates. I think the rates go from 0.051% to 0.331% of your gross receipts. So again, that's brand new. That's effective July 1st of 2015. The first return that will be due will be in August of 2016. Again, it's this trend that we're seeing, states getting away from corporate income tax and going more to a gross receipts tax. So some questions to ask yourself as far as understanding your multi-state tax filing obligations. So from a sales and use tax perspective, some questions to ask is, do you have a traveling sales force? Do you perform installation or other services outside of Illinois? Do you make sales primarily to customers that can issue exemption certificates? You know, this is a great example. Maybe from a sales tax perspective, you can collect certificates from all your customers and you don't have a filing requirement from a sales tax perspective. But what about the other tax types in a particular state? Income tax, franchise tax, gross receipts tax. So what I'm seeing a lot more of my clients and companies do these days is they may not be physically located in a state, but what they're actually doing is they're actually requesting customers for exemption certificates for the states, some of the bigger states that they're shipping into. Only from the standpoint that if a state would come calling someday, that they would actually have that backup documentation to show that those sales are exempt from tax. That goes really back to this next point is, do you have a system in place to document customer exemption certificates? From my earlier comment, for states being more aggressive on audits, do you have somebody internally reviewing your certificates when they come in to make sure they're complete? The name's on there, the exemption boxes are checked. It's signed, it's dated. Again, going back to states being aggressive, auditors being aggressive, they're trying to find any way possible to disallow a certificate and generate tax on an audit. And having you go back and actually try to find, get a new certificate. And the problem is, companies go out of business, companies merge, sold. It might be difficult 2 or 3 years down the road to get a new certificate from somebody if an auditor disallows a certificate. So from a compliance perspective, it's always great to have a system in place that somebody's checking over the certificates when they're coming in and make sure they're complete. Do you make sales over the internet? So here's a situation. So maybe you have a company that makes all wholesale sales. They sell all to distributors. So all their sales are exempt from sales tax. But what they're deciding to do is they're actually selling over the internet to end user customers because the distributors don't want to get involved as far as like on repair parts. So while a company may have a filing obligation from a sales tax perspective, they say, well, no, you know what, all of our sales are to end user customers, we can take certificates. Once you start making those sales over the internet to end user customers, you might have a sales tax obligation on those sales. And the other thing is, do you know if your services are exempt in other states? Not all states impose tax on separately stated services, but there are those states out there that do. Other issues to consider from a sales tax perspective is, do you have warehousing or distribution facilities in other states? Do you have inventory? Have you been recently audited for state sales tax? And I like to maybe just focus on this one a little bit. Because if a company has multiple locations, maybe one state has been through for a sales and use tax audit, can you take what you learned in that audit for that state and apply it to the other states you're doing business in? Maybe change some of your procedures internally so you don't avoid those same errors in the other states. Companies that are doing business in a lot of states from a sales tax perspective that actually have retail sales are automating their technologies or automating their sales tax process these days with technology solutions. The common ones that you hear out there are Avalara, CCH, and Vertex. So we have a partner arrangement with Vertex SMB. They're a division of Vertex. But again, it's just another company that you can outsource your sales tax rate information. You get rate information, do the returns, and everything else. So a starting point from a state income tax perspective, franchise tax, again, the requirements are generally going to be from a franchise or capital tax are generally be identical to sales tax. State income tax Nexus requirements are going to vary slightly from sales and use tax. You got to go through and look at the regulations. Ask similar questions as far as what we did when the sales tax, as far as determine whether you have a filing requirement for state income tax. Are you currently filing any multi-state returns outside of your home state right now? If you're filing, we'll talk a little bit more in the compliance and risk area. But I think the last bullet point here, identify potential risk for noncompliance. More and more companies are starting to do this. Withholding tax. Currently from a withholding tax perspective, there is not a bright line test that a company can apply if you've got employees that go and travel into all states. Now there's been several attempts at federal legislation at this, but nothing has gone through. So we're seeing some more and more states pick up on employee withholding. What's the deal there is, again, states are being aggressive. They're looking for revenue. So what better way to try to find employees that are visiting their states that are performing services, doing training or whatever it might be. Because when it comes to withholding perspective, not all states have the same rules. Some states may say it's based on a set number of days that somebody is based or is in their state. Some states may say it's tied to a specific dollar amount. Then you've got a withholding obligation at state. The other question to ask is, do you have reciprocity? So you have Illinois, so you have reciprocity with Michigan, Kentucky, Iowa, and Wisconsin. So in that case, if those employees are going back and forth, there's reciprocity, and those employees won't incur an additional filing requirement on wage income in those other states. In some states, from a state income tax perspective, an employer may lose a deduction for wages not properly reported. Doesn't happen very often, but we do see that from time to time. And really what happens really here after the fact is, if a state comes after a company for withholding tax, oftentimes what happens is the employer bears that responsibility to pay that tax in for what would have been due by that employee that would actually file that return with the state. And the complexity with the withholding tax, again, with no bright line test, it's really your employees that are affected, because not only do they have to file a return here in Illinois, but they might have a filing obligation in another state. And now what? That simple return that they use their software, they don't feel comfortable preparing another state's return. So it adds not a layer of complexity only for the company, but at the employee level too as well. Property tax, again, it's often overlooked. I think when you look at sales tax, income tax, franchise tax, there has to be specific situations in other states where they might have a real estate tax, they may have a personal property tax. And it's not only at the state level that you got to worry about, but it's at the local level too as well. So that's another area that you want to look at. If you're a company that's leasing or renting equipment, obviously you want to look to see where that equipment is at the end of the year, to see if you might have a filing requirement for property tax purposes if they impose a tax on personal property, either at the state level or at the local level. So registering to transact business in a state. A lot of companies will, there's business reasons why a company will register to transact business as a state as a foreign corporation outside of where they're domestically headquartered. Again, a lot of times when it comes to registering as a foreign corporation, I always recommend to go run it past outside counsel, because are there penalties for a company for failure to register? If you're doing business in a state and you're not registered, if you're conducting business in a state but you're not registered to transact business in the state with the Secretary of State, are there penalties for failure to register? Will the company lose their ability to avail yourself of the state's legal system? Which I understand, which is a lot of times the reasons why a state will register with the Secretary of State, so that if a situation would come up with a customer, that they could bring suit in a court within that state. What they don't realize is when you register to transact business, that information may get funneled over to the Revenue Department. And at the last point here, will you need a registered agent? One of the mistakes I see companies do is what they will, when they're doing business and they have an employee in a state, they will list the employee as a registered agent in the state. And the reason why it's not recommended is, if you get rid of your employee, where's all that paperwork, where's all that legal notifications going to? Because a lot of times the individuals that set that registration up forget that they use the employee in the state. So there's a lot of outside agencies, CIT, other ones that you can use that will monitor and do those registrations for you. So I'll talk a little bit more about this at the last part on the reviewing your requirements or reviewing your particular situation with state taxes. But again, what you want to do is you want to line up your registrations, and I've got a handout that we'll go through at the end of towards the end of the presentation. So why is it important to address state and local tax issues proactively? Again, one, minimize potential risk from non-compliance. Going back to my earlier comment, if you don't file returns in the state, there's no tolling of the statute of limitations. So a small tax amount could turn into a large liability from a penalties and the interest that are added on. Secure necessary tax savings. So in this particular situation is if you're a flow-through entity and you're filing here in the state of Illinois, but you're doing business in other states, Those other states may go back 4, 5, 6, 7, 8 years, but she can only go back to the state of Illinois to file an amended return for taxes paid to another state for 3 years. So guess what happens for years 4, 5, 6, 7, 8, and 9? Those taxes are being borne by the company. That liability is going to be at the company level. Cash flow, tax liabilities are known and can be budgeted. I think that's key. I talked a little bit about taxes paid to other states you can recoup from a statute of limitation perspective. But the other reason for being proactive on return, from a filing perspective, is when you're filing a return, you're tolling the statute of limitations. So if an auditor were to come in, they can only go back 3 years or 4 years or whatever it might be, rather than 5, 6, 7, or 8 years. Returns done after the fact, from a cost perspective, compliance are always more. So these next two slides. So on this particular side, another reason why to be proactive is if you're looking to sell your business. So a lot of times what will happen is when you sell your business, a purchaser will have a due diligence team come in, and most likely there'll be a tax team associated with that. What they're going to do is they're going to go through from a state and local tax perspective is they're going to try to identify any potential issues that the company had a filing requirement for that didn't file returns. And ultimately what they're going to try to do is to have the sales price, have some money set aside until those liabilities are taken care of. So again, if a company is not addressing proactively their state and local tax issues and you're looking to sell, if the other party comes in to do due diligence, they're looking to assess what risk there might be in other states so it doesn't foul them when they actually go through with the transaction. So from the purchaser side, again, if I'm a company looking to buy another company, I want to know what issues are out there from a multi-state tax filing perspective, because a lot of times what happens is from a sales and use tax perspective, even from an income tax perspective, depending upon how the sale arrangement takes place, there's a potential for successor liability of those taxes coming through from the seller to the purchaser. Most states, or some states, have clearance certificates, meaning that the parties can go through a process, or the seller can go through a process, getting a clearance certificate from the Revenue Department showing that all taxes have been paid. The problem with going through the clearance certificate route is that sometimes that could trigger an audit, and people don't like audits. So compliance and minimizing exposure and risk. So identifying states where a company has tax filing requirements. So one of the ways to do it would be to complete a Nexus questionnaire or have an outside company perform a Nexus study. Again, you might not have risk from a sales tax perspective because of sales for resale, but you might have an obligation for other states. You know, if you look at this handout that I have attached here, these last two attachments, you know, trying to understand what your risk might be. Why don't you just look at attachment 2 first. So this is a pretty simple process that you can do to understand where you might have a filing requirement in other states, both, you know, from a sales tax perspective, income tax, or gross receipts. So what I like to do is I like to get a total year of sales of shipped to, okay, from a company, and then sort from largest to smallest. Then what I do is on attachment 1, try to summarize for the biggest states, because if you look, and we're just looking from a starting point here. So this company on page 2 has 33 million, close to 34 million of sales. But if I look at what states generate generate those sales, there's 12 states, including Illinois. So 80% of my sales in the US are to 12 states. So if I'm looking from a starting point perspective on where I might want to look at for my filing obligations in other states, let's look at those 12 states first. Then what I might do is come over to attachment 1. And maybe for those 12 states, I list out, when on the left-hand side, the states, it's basically very simple. You know, a column for sales tax, payroll tax, property tax, income tax, non-income-based taxes, and then register to do business with the Secretary of State. And as you can see, spell check doesn't always work all the time. So I just saw that before, so apologize for that. But here again, this is just kind of like a high-level overview, okay? So as you can see, if you mark for this particular company where they're registered from a tax type perspective, all right, Illinois, we're fine. So I might say in California, okay, what's triggering from a payroll employment tax perspective? All right, if we're registered for payroll, why aren't we filing sales tax? Why aren't we filing income franchise tax returns? Why aren't we registered to do business in the state? Same thing all the way down. State of Washington, I'm registered for sales tax, I'm registered for payroll, but for some reason I'm not filing B&O tax returns, okay? So I look at this as maybe like the low-hanging fruit. So I mean, by doing a simple analysis here for these 12 states, initially what I've done is I've at least addressed 80% of my sales for a given year. Now that's just a starting point, okay? So once I've identified that I want to maybe pursue something for these 12 states initially, then what I might do is maybe run a calculation. I might run a calculation to see, well, what's my potential sales tax risk? What's my potential income tax or franchise tax or gross receipts tax risk? So what I want to try to do is identify what's my risk in each of these states. And every company has a different level of risk that they're willing to work with. But again, I mean, the object here is to identify these 12 states. Am I in compliance? And then what do I do? Do I do a voluntary disclosure agreement? Because maybe I have this activity in the prior years, or do I do go forward filings only? And I'll talk a little bit about voluntary disclosure, but on the next slide. But the key thing here is, I think a lot of us might be aware of, is when you register for sales tax in a state, that bottom statement, I declare under penalties of law that I have examined this information and to the best of my knowledge and belief it is true, correct, and complete. There's one section in these sales tax, these registration agreements that the states always ask for. When did you start first doing business in the state? So what do you put in there? You've been doing business in there for 10 years. You're going to do maybe go forward only. You put 1/1 of 2016. It opens up the door for the state to go back further. And trust me, if you accidentally register in a state and you say you've been doing business for the last 8 years, and you put back in there you've been doing business since January 1st of 2007, a state will not miss that. They'll send you returns back, going back that far to complete. So you got to be very careful when you're filling out those registration documents. So voluntary disclosure. All right, so what's voluntary disclosure? Most states have a voluntary disclosure program where you, a company, can proactively come forward and disclose that you had a responsibility to file returns for prior years. Now what the states will do is they will reward a company for coming through on voluntary disclosure by, one, limiting the look-back period to maybe 3 or 4 years. Two, they'll waive penalties. And everything before that 3 or 4 year period gets wiped off the slate. So what happens is you've got the 3 or 4 years that you've got to file returns for, and then you've got you'd be filing returns on a go-forward basis too as well. And the only exception on the next bullet point, done anonymously. So most states will say that a third party can come forward and disclose that company XYZ has this filing obligation. Here's the terms of our conditions that we seek for this voluntary disclosure. If you get an agreement back from that state and you don't like their terms or conditions, you can walk away because your company name has not been disclosed. But there's 2 states that's where you have to disclose your name. Is Illinois is one ahead of time, and New York State too. And New York, 2 states that I'm aware of. But most other states you can do on a no-name basis, an anonymous basis. And again, if you don't like their terms and conditions, you can walk away. This certainly is not a problem. Voluntary disclosure is only available for companies that aren't registered and filing for that type of tax involved, and they've not been contacted by the state for any past due liability. So oftentimes from a voluntary disclosure perspective, what the other opportunity might be is what you hear is amnesty, okay? In this past year, we had almost 9 states that offered some type of amnesty program. You know, it is almost close to 11:30. Is that my signal? Okay. All right, so I'll just end on this slide right here, the last slide, because we're almost to the end. But just remember this, at the end of the day, Nexus is a complex issue that is ever-changing and needs to be constantly monitored. It is a continuing tax, not a one-and-done situation. So once you evaluate your Nexus requirements, they may change the next year. And this is probably the most common fact that I see, that most times the individual responsible for the tax function or multi-state tax filings of a business is the last person to find out about changes in the company's footprint and does not have time to evaluate the impact it might have on a company's tax filing requirements. Communication internally, marketing, sales or whatever, doesn't communicate with the controller, the CFO, where they're going to be going, and then voila, you've got a tax filing requirement. So again, communication within a company goes a long way with helping determine where somebody's footprint is from a Nexus perspective. So really at the end of the day, the company may make a business decision to do nothing and maybe monitor developments on a go-forward basis, register and file returns in all states it does business in, or going back to the point, the schedules I had right here, determine a starting point of prioritization of addressing the larger risk states first and then addressing the lower tier states afterwards. Again, going back to the first comment, it's a continuing tax, it's a continuing monitoring.